How's it going, everybody? It's me, Mr. Drake, and I'm back once again because today I want to give you the best chance to get a mortgage approval by avoiding these 10 major mortgage pitfalls. As we go through this list, you'll need to assess yourself against each of them to see whether it's something that's going to affect you getting a mortgage approved. If a mortgage application is denied, it leaves a mark on your credit file and marginally reduces your credit score. This will make it slightly tougher in future to get credit applications approved. Though it's not the end of the world to be denied a mortgage, I suggest you put your best foot forward to get into your new home on the best rate mortgage available, because this could save you thousands to tens of thousands of pounds over the course of the 30 years. Before going into the video though, I have to say, generally speaking, I don't trust people that deal in money. This is because there is so much profit to be made from it, and their pursuit is always in making more money. Buying a home on a mortgage is becoming dangerous, and this is my honest warning about home equity borrowing. Lenders are becoming increasingly desperate to lend money as the pool of borrowers starts to dry up. This means that more and more outrageous types of mortgage are going to become available, which are designed to boost the profits of the lender. This can only mean greater risk and greater cost for the borrower. It's already started to happen, so be hyper aware of what you're getting yourself into, and I will explain more in a future video. Today's video takes on a listicle format, but in video form, so that's like a listicalidio, I think. Anyway, we're going to go from the least to the most common, so let's get stuck in with number 1. When lending such large amounts of money, lenders tend to evaluate risk to very minute details. If you haven't been a UK resident for at least 3 years, many mortgage lenders will deny your application just on this basis. Not all lenders though, so do a quick search online for UK mortgages available to non-UK residents, or alternatively, UK mortgages available to UK residents for less than 3 years. Many mortgage lenders won't lend to somebody who'll still be paying off the property into their retirement because of the reduction in their income. Check with a mortgage lender beforehand to see if they have any information on age ranges they will and won't lend to. Many still will lend to elder applicants, but it will narrow your options a bit. An alternative solution would be to save a larger deposit and take a shorter term than mortgage, sort of 15 to 25 years. This will cost you slightly more per month, but it will mean that your mortgage is cleared before retirement, and you will also end up paying slightly less interest over the term of the mortgage. This can be a common occurrence, but it gets flushed out very early in the process because you won't receive an agreement in principle if you don't match the lender's profile. It can be based on anything from age to location and region, property value, even things like income. An experienced mortgage advisor will know which lender's profiles you fit, so that will help you avoid reaching that point. Not receiving an agreement in principle won't affect your credit score, but if the lender does a hard credit check on you, that will show up on your credit report and it will affect your credit score. I've discussed this in a previous video. As a rule of thumb, mortgage lenders will need at least 3 years full employment history. This is so that they can work out your average income over the years, because some months and years you may have earned more or less. If you're self-employed, you can use your tax returns as evidence of taxable income. Your mortgage advisor will tell you up front, or it will tell you online, what documentation they'll need from you to assess your suitability for a mortgage, and this will include the number of years employment history that they'll need from you. You can avoid being declined just by making sure you provide the right documentation. If you apply for a current account, an overdraft, a credit card, a loan, or a mortgage, they all count as credit applications. If you make too many credit applications in a short space of time, you'll seem desperate for credit. This can make you seem like a riskier borrower, so to minimise the risk, make less credit applications and try to make less than 1 per 6 months if you know you're applying for a mortgage soon. Once again, that list is a current account, an overdraft, a loan including finance agreements, a credit card and a mortgage. If you're not enrolled to vote, you could well be denied a mortgage just because the lender couldn't verify you against your current address. It's super simple to do. Enroll online, and once you've enrolled, you remain enrolled unless you change address. If this happens, all you need to do is re-enroll with your new address. Personally, I do not think it's a good idea to buy a property with anything less than a 15% deposit, so the solution to this would be to save at least a 15% deposit on a property. However, if this isn't the case, there are 3 potential problems. Number 1 would be the cost of the mortgage. Number 2 would be the potential risk of the application being declined. And number 3 would be the potential of the mortgage going underwater. Once again, a mortgage lender is just trying to determine the risk of them not getting their money back. And a high loan-to-value mortgage is a big risk for them, because if you fail to repay the mortgage, they'll repossess the property. But they need to make sure the value of the property is greater than the value of the mortgage. And if the property goes underwater, they stand to lose money. The closer the total of the mortgage is to the total value of the property, the riskier this becomes for you and the lender. If the loan-to-value becomes too high, hopefully they will just reject your application. But they may make you an offer. You see, a home buyer's most exploited trait is their eagerness to become a property buyer, and humans love acceptance, and it seems to be regardless of the terms and conditions. What this means is an offer will be made to you, and it will be used to squeeze every drop out of you until you've got nothing left to give. This could literally result in you giving them the shirt off your back. When all said and done, a 0.2% increase in your mortgage interest will make your loan about 2.5% more expensive across a 30-year term. Riskier borrowers could be paying 0.5% plus more interest on their mortgage, which could cost over £10,000 during the life of the mortgage. And if they offer you a 40-year mortgage, tell them to stick it where the sun don't shine. If you want to know why, I'll do a video on exploitative mortgages soon. The longer the gap in time between receiving your agreement in principle and making your final mortgage request, the riskier this becomes. It's also got a bit of a grey area around it, because different mortgage lenders will show different levels of scrutiny to any changes made. Changes could be things like significant changes to your income, new credit applications made by you, for example a 0% credit card to put all those home furnishings on. If the mortgage lender discovers any problems with the property during the survey, that will affect the property's value, and it will also affect the loan to value ratio. With a lower property value, they're going to be willing to offer you a lower mortgage, and they may also just decline the mortgage outright if there's too many problems with the property, or they think you're excessively overpaying for the property. It could also include changes to their ability to lend money. If they're a smaller mortgage lender, they may have used an available cap for credit offers, and if they've used that cap, they can't offer any more credit. You won't be notified of any of the changes if you're rejected, so there's not really much we can do about it. All we can do is make ourselves seem like the perfect borrowers, keeping our risk factor as low as we can, and keep our fingers crossed that that's good enough. If changes are made to the terms and you are still accepted, you'll be informed of the new changes to the terms before you sign, and you can always reject them from there. It's worth taking a few agreements in principle with you through to the final mortgage offer process, so that way you have a fallback in case one of them changes its terms or gets rejected. Unless you've lived a very sheltered life, it's unlikely you have no credit history. However, if you have no credit history, there's no framework to qualify whether you're a reliable borrower. So it's unlikely, unless you fly through the affordability tests, that you would have a mortgage accepted. If you do have no credit history, you can build your credit rating by enrolling on the electoral register, taking out a basic credit card and making nominal purchases on it, making sure you pay off the full credit balance on each statement, and taking out a few utility bills in your name and making sure they're paid off on time. At least with a poor credit rating, your lender will be able to qualify you against different types of mortgage. Improving a poor credit rating is the same as improving no credit rating, with the additions of clearing any debt that you have so that you're accessing less total credit and cancelling any unused credit cards that you have. If you have a poor credit rating or no credit rating at all, you may well be offered riskier mortgages. This is because you yourself have been deemed a riskier borrower. Do not take out a risky mortgage because it's something you could end up paying for the rest of your life. Firstly, what you need to do is improve your credit rating and then go back to the table in a better position to see what's available to you then. This is measured using a debt to income ratio. It also includes any debts that you currently have outstanding. The total debt is measured against your yearly income. For example, if you had a £2,000 credit card and a £5,000 car finance plan, that would be £7,000 against an annual salary of, let's say, £20,000. Now, a low risk mortgage has a cap for the debt to income ratio of 4.5 or less. Anything above a 4.5 multiplier is seen as a risky mortgage, which will cost you more in the long term. So for that £20,000 a year salary, the maximum mortgage available will be £90,000. However, with your outstanding debts, they are part of the ratio, so your £90,000 mortgage offering would actually be £83,000 after your other debts are included. As well as your debt to income ratio, your affordability will be measured on your cash flow. This is your income minus your expenses. If your mortgage lender sees that you have exceptionally high expenses relative to your income, you'll be seen as an affordability risk. An example of this would be someone who's living at home with no rent to pay, but still manages to spend 90% of their income. When considering your expenses, rent and renter's insurance aren't considered because they are two expenses that will end once you've bought a property. If you have a low or negative cash flow, you can improve this by clearing your current debts first before applying for a mortgage, as having no debt repayments will reduce your monthly expenses. Increasing your income or controlling your spending is to help lower your expenses. Because if I bring up the example that we used before again, you'll see that with no debts and a £5,000 a year higher income, you could go from an £83,000 mortgage to a £112,500 mortgage in just a couple of years. A great mortgage applicant will have UK residency for 3 or more years, at least 3 years consistent income, a debt to income ratio of less than a multiplier of 4, no other debts, a good to great credit rating, a 20% deposit and surplus cash flow. This type of borrower will have their pick of the best mortgages available because their risk profile is so low. As long as they don't do anything to change that between the agreement in principle and making their final mortgage request, and they don't excessively overpay on the value of the property, the mortgage process will be smooth sailing for them. If you're thinking about applying for a mortgage or know that it's a few years down the line, become this type of borrower first, and it could save you thousands to tens of thousands of pounds over the course of your mortgage. It was only in researching this video I realised how many of these I'd currently fail if I applied for a mortgage today. That would see my applications rejected, or I'd be offered a more expensive mortgage because the lender's going to try and squeeze as much money out of the deal as they can in case I fail on my repayments. Your mortgage is going to be a big expense for the next 30 years of your life, so why accept paying thousands more than you have to? Become an attractive borrower. Stay cash flow strong and turn your wages into wealth. I'm going to see you in the next video where I am sending some shots at the mortgage industry. So stay tuned for that. I'll see you in a week. Have a wonderful day, guys. I hope you found this useful. Adios, amigos.